As Canada's ties with the United States fray, Prime Minister Mark Carney moves to strengthen ties with Europe.
108,000 Americans lost their jobs in a single month. Europe redirected hundreds of billions of dollars away from the United States, and Canada quietly absorbed the capital, all while Washington continued to declare the economy stronger than ever. That single sentence captures the core of what is unfolding right now. In January 2026 alone, the job cut announcements across the United States surged to levels last seen during the Great Recession of 2009. The depth of the Great Recession. What most viewers have not been told is why these decisions happened so quickly, how trade war policy amplified the damage inside the United States, and what a hidden indicator reveals about where this trajectory is heading next. Listen to the end today, because I will disclose a suppressed indicator that has never been clearly published, one that reveals damage so severe it redefines the real cost of this trade war for the United States. The employment shock did not remain confined to payroll statistics. Within weeks of the 108,000 layoffs, capital markets began reacting in ways historically associated with early recession signals. According to publicly available Treasury data, foreign holdings of United States government debt declined for 2 consecutive reporting periods, while yields on the 10-year Treasury note moved above 5% for the first time in years. At the same time, the dollar weakened against major European currencies. When bond yields rise while the currency softens, investors are not simply rotating assets inside the United States, they are reducing exposure. That distinction matters. Equity volatility increased sharply across major indices. Several multinational firms announced hiring freezes, capital expenditure delays, and cost containment programs explicitly linked to tariff uncertainty and slowing demand. Corporate earnings guidance revisions turned negative across transportation, industrial manufacturing, and consumer discretionary sectors. Analysts described the tone shift as defensive rather than cyclical. This is where the trade war becomes central. Expanded tariff measures affecting European industrial goods and Canadian aluminum introduced pricing unpredictability into supply chains that operate on multi-year planning cycles. When companies cannot model input costs with confidence, they preserve margins by reducing labor. The January layoffs were formulated during the final quarter of the previous year, precisely when tariff escalation intensified. Foreign direct investment into the United States had already slowed prior to this employment shock. International investors now face a convergence of risk variables: rising sovereign borrowing costs, expanding fiscal deficits, labor market contraction, and retaliatory trade measures. In capital markets, convergence of risk accelerates repricing. Meanwhile, Canada has not experienced comparable sovereign stress indicators. Canadian federal debt levels remain significantly lower relative to economic output than those of the United States, and trade diversification agreements with Europe provide alternative demand channels amid trade war escalation. As American volatility increases, capital seeks predictability. Canada is increasingly positioned as that alternative within North America. The question is no longer whether layoffs signal weakness. The deeper issue is whether the trade war has triggered a structural capital rotation that could persist well beyond a single quarter. And what institutional risk committees are modeling behind closed doors may prove far more consequential than any headline figure released so far. If employment loss was the ignition point, the secondary shock is now spreading through the core engine of the United States economy: consumption. Roughly 70% of economic output in the United States is driven by consumer spending. When layoffs accelerate, spending does not decline gradually. It contracts in layers. Retail sales have shown measurable weakening in recent months, particularly in discretionary categories such as home furnishings, electronics, and mid-market apparel. Credit card balances nationally remain near record highs, while delinquency rates have climbed to levels not seen in more than a decade. Auto loan stress is rising, particularly among lower-income households. Mortgage rates remain elevated relative to pre-pandemic norms, suppressing housing demand and construction activity. Housing is not just shelter. It is collateral. When home sales slow and prices stagnate or decline in certain regions, household wealth perceptions shift. That shift alters spending behavior. Reduced spending weakens corporate revenue. Weakened revenue pressures margins. Margins trigger additional layoffs. The cycle reinforces itself. This is how recession spirals form. At the federal level, fiscal constraints limit rapid response. Public debt in the United States exceeds $35 trillion. As interest rates remain elevated, annual debt servicing costs consume a growing share of federal revenue. Higher yields increase refinancing costs for corporations and municipalities. States dependent on income tax revenue face widening budget gaps as unemployment rises. Pension systems, already under long-term demographic strain, become more vulnerable during equity market volatility. The trade war compounds this pressure. Tariff escalation affects export sectors directly, particularly agriculture, aerospace components, and industrial machinery. Retaliatory measures from trading partners reduce foreign demand for American goods. When export volumes decline at the same time domestic consumption weakens, economic buffers thin rapidly. Small and medium-sized businesses are especially exposed. They lack the pricing power and capital reserves of multinational corporations. Tighter lending standards from regional banks, combined with softer demand, increase bankruptcy risk. Each business closure represents not just lost jobs, but lost tax revenue, lost local services, and weakened community stability. At this stage, the risk is not limited to quarterly growth fluctuations. The risk is structural confidence erosion. When households reduce spending, businesses reduce investment, and governments face constrained fiscal flexibility simultaneously, recovery becomes more difficult and more prolonged. Canada, in contrast, has pursued diversification rather than escalation. Trade agreements with European partners and alignment with carbon border adjustment standards have provided alternative export pathways. While Canada faces its own sectoral adjustments, it has not experienced the same convergence of labor contraction, sovereign strain, and tariff volatility that now characterizes the United States. This divergence is not theoretical. Investors model it daily. If unemployment continues rising while borrowing costs remain elevated and the trade war expands, the next phase will not be defined by layoffs alone. It will be defined by sovereign credibility and how global capital responds when it begins questioning the long-term stability of the United States. And the most sensitive indicator of that credibility shift has not yet reached its critical threshold. When it does, the consequences may unfold faster than markets are currently pricing. The labor contraction inside the United States is not occurring in isolation. It is unfolding in parallel with an expanding trade war that is reshaping global supply chains, redirecting capital flows, and accelerating strategic realignment across North America and Europe. In late 2025, the United States broadened tariff measures targeting European industrial components, Canadian aluminum, advanced manufacturing inputs, and selected technology hardware originating in Asia. The stated objective was domestic protection and strategic leverage. The market interpretation was different. Markets saw unpredictability. Retaliation followed swiftly. European authorities implemented counter tariffs affecting tens of billions of dollars in American exports, including agricultural products, machinery, aerospace components, and consumer goods. Canada adjusted procurement frameworks and strengthened transatlantic trade corridors under existing agreements with the European Union and Asia-Pacific partners. Supply chain managers responded not with public statements, but with contract revisions. This is where the trade war magnifies economic fragility. When multinational firms cannot forecast tariff exposure across multi-year investment cycles, they pause expansion. When they pause expansion, capital expenditures decline. When capital expenditures decline, manufacturing activity slows. When manufacturing slows, layoffs accelerate. Recent customs and trade flow data indicate measurable compression in certain United States export categories. Agricultural producers have reported weaker foreign demand. Industrial machinery shipments to Europe have softened. Logistics operators have signaled reduced throughput volumes in specific port regions compared to previous year levels. Simultaneously, Canada has expanded export volumes in sectors aligned with European decarbonization policy. Canadian aluminum producers, supported by hydroelectric energy generation, have secured long-term agreements with European buyers seeking lower carbon intensity inputs. Energy infrastructure projects in Western Canada have attracted renewed institutional interest. Provincial bond issuances have seen sustained international demand relative to comparable American municipal securities. This divergence is subtle but strategic. The United States continues to represent the largest single consumer market in the world. However, market size alone does not guarantee capital loyalty. Investors evaluate risk-adjusted return. If tariff volatility increases compliance costs and introduces legal uncertainty into contract enforcement, global firms hedge exposure. The result is gradual reallocation rather than dramatic exit. European pension funds managing trillions in assets routinely rebalance portfolios based on forward risk modeling. If earnings visibility in the United States declines due to trade war escalation and labor market weakness, allocation weights adjust. The reallocation may not appear dramatic week to week. Over quarters, it compounds. Currency markets provide additional context. When bond yields in the United States rise due to fiscal strain, yet the dollar weakens simultaneously, the signal reflects cautious foreign demand rather than domestic rotation. Confidence is a premium variable. When that premium compresses, capital diversifies. Canada benefits from geographic proximity, regulatory familiarity, and participation in established trade frameworks. As the trade war complicates American export access, Canada positions itself as a stable intermediary between European demand and North American production capacity. Stability in a fragmented global environment becomes an economic asset. Inside the United States, the cumulative effect of trade war escalation, employment contraction, and fiscal strain increases systemic sensitivity. Corporate debt rollover risk rises in higher rate environments. State budgets tighten as revenue projections weaken. Consumer sentiment declines further when headlines reinforce uncertainty. None of these variables alone define collapse. Together, they define vulnerability. The core question is whether the trade war has shifted from negotiation tactic to structural drag. If retaliatory measures persist and supply chain fragmentation deepens, the United States may face prolonged competitiveness challenges in sectors previously considered secure. Meanwhile, Canada continues integrating with European partners under predictable regulatory regimes. Investment committees across Frankfurt, Amsterdam, and Copenhagen increasingly reference Canada as a stable North American allocation in an era of American volatility. The next development may not appear first in employment data or export figures. It may appear in long-term capital commitments quietly signed outside United States jurisdiction. And once those commitments are locked into multi-year infrastructure, energy, and manufacturing contracts, reversing the capital flow will be significantly more difficult than initiating it. By the middle of 2026, the discussion is no longer confined to layoffs, tariffs, or quarterly earnings. The conversation has shifted towards sovereign credibility, and that is a far more serious frontier. Public debt in the United States now exceeds $36 trillion at current yield levels. Annual interest payments are approaching $1.8 trillion. That figure rivals or surpasses major federal spending categories. When debt servicing grows faster than revenue, fiscal flexibility narrows. When fiscal flexibility narrows during economic contraction, policy options shrink. This is the structural constraint distinguishing 2026 from 2009. During the financial crisis, policymakers had significant rate-cutting capacity and comparatively lower sovereign debt burdens. Today, elevated rates coexist with record nominal debt levels. If unemployment accelerates while borrowing costs remain high, large-scale stimulus becomes more expensive to finance. Markets understand this arithmetic. Treasury auctions continue to clear, but at increasingly elevated yields. Bid-to-cover ratios have shown periods of softening compared to prior years. Foreign participation in long-dated securities has moderated. While not a funding crisis, it represents a repricing of risk. Sovereign risk does not begin with default. It begins with rising cost of capital. Credit markets are reacting accordingly. Corporate bond spreads have widened relative to benchmarks. Refinancing risk is building for firms that accumulated debt during low-rate periods and now face higher rollover costs amid slowing revenue growth. When refinancing becomes expensive, cost-cutting intensifies. Cost-cutting returns to layoffs. The cycle tightens. Municipal finance adds another layer of vulnerability. State governments reliant on income and sales tax revenues are already revising budget forecasts downward. Pension funding gaps widen during equity volatility. If unemployment surpasses 8% nationally, unemployment insurance systems and social safety expenditures increase significantly, pressuring already strained state budgets. Meanwhile, the trade war continues to impose structural friction. Retaliatory tariffs reduce export competitiveness. Import costs remain volatile. Supply chains fragment. The combined effect erodes productivity growth. Productivity stagnation in a high-debt environment magnifies long-term fiscal strain. International investors assess sovereign resilience through several lenses: debt trajectory, growth outlook, political stability, and policy coherence. In recent quarters, all four metrics have experienced pressure within the United States. Political polarization complicates coordinated fiscal action. Growth projections are being revised downward, debt continues expanding, trade policy volatility reduces external predictability. Canada presents a contrasting profile. Federal debt relative to economic output remains substantially lower than that of the United States. Monetary authorities retain comparatively greater maneuverability. Trade relationships with Europe and Asia are being deepened rather than disrupted. In global asset allocation frameworks, that combination translates into a stability premium. The difference is not dramatic rhetoric. It is incremental divergence. Foreign direct investment pipelines reflect this divergence. Long-term capital commitments in energy infrastructure, clean manufacturing, and resource processing are increasingly directed toward Canadian provinces rather than American states exposed to tariff retaliation. Once capital is deployed into infrastructure corridors, energy grids, or industrial clusters, it does not migrate easily. The credibility threshold approaches when markets begin questioning not whether the United States can finance its obligations, but at what cost. If debt servicing continues rising while economic growth slows and trade war friction persists, the United States risks entering a prolonged period of higher structural borrowing costs. Higher borrowing costs suppress private investment. Suppressed investment reduces productivity growth. Reduced productivity constrains wage growth. Slower wage growth weakens consumption. The spiral becomes entrenched. This is the systemic dimension few public statements emphasize. The initial 108,000 layoffs were visible. The structural repricing of sovereign credibility is quieter, but potentially far more consequential. If international capital concludes that volatility is not temporary but structural, portfolio allocations adjust for years, not quarters. The defining variable will not be the next monthly employment report. It will be whether the United States can restore policy coherence amid an intensifying trade war without further undermining investor confidence. Because once global capital embeds a higher risk premium into American assets, reversing that perception becomes exponentially more difficult. By late 2026, the issue is no longer whether the United States is experiencing a downturn. The deeper issue is whether the global system is recalibrating around it. The trade war was initially framed as leverage, a negotiation tactic designed to secure better terms. Instead, it has introduced persistent volatility into cross-border commerce. Supply chains have adjusted. Capital allocation models have adjusted. Risk premiums have adjusted. And once those adjustments become embedded, they do not unwind easily. Consider the structural picture. Employment contraction exceeding 500,000 announced job cuts within 2 quarters. Federal debt surpassing $36 trillion. Annual interest obligations approaching $2 trillion. Export volumes compressed under retaliatory tariffs. Credit spreads widening. Consumer delinquencies rising. Housing activity slowing. Corporate capital expenditure plans revised downward by hundreds of billions of dollars. Individually, each data point is manageable. Collectively, they form a pattern. Patterns are what institutional investors analyze. The United States has historically benefited from what economists call the exorbitant privilege, the ability to borrow at lower cost due to reserve currency status and global confidence. That privilege is not revoked suddenly. It erodes gradually through credibility compression. If trade war escalation continues while growth weakens and fiscal strain intensifies, markets may begin embedding a structural risk premium into long-term American assets. That would mean persistently higher borrowing costs, even outside crisis periods. Higher baseline yields would ripple through mortgages, auto loans, student loans, municipal bonds, and corporate finance. Such a shift would redefine competitiveness. Meanwhile, Canada is consolidating strategic advantages. Trade diversification agreements provide access to European markets without escalating tariff conflict. Energy exports align with decarbonization frameworks. Infrastructure investment supported by foreign pension capital strengthens logistics corridors linking North America to transatlantic partners. Regulatory predictability enhances long-term contract visibility. Canada is not replacing the United States as a global economic anchor, but it is capturing marginal capital flows that once defaulted south. Marginal shifts compound. If even a small percentage of global institutional portfolios reweight exposure from the United States toward Canada and Northern Europe over multiple years, the cumulative impact on American capital markets could be significant. Lower inbound investment reduces liquidity depth. Reduced liquidity increases volatility sensitivity. Higher volatility deters additional capital. The feedback loop reinforces itself. The trade war accelerates this rebalancing. Retaliatory tariffs reduce American export competitiveness. Companies facing unpredictable cross-border costs hedge by relocating incremental investment to jurisdictions with clearer policy frameworks. Once new production lines, research centers, and supply hubs are built outside the United States, reversing that footprint becomes economically irrational. The long-term risk is not a single recession. It is a decade of slower relative growth. Slower growth constrains wage expansion. Constrained wages limit consumption. Limited consumption restrains tax revenue. Restrained tax revenue complicates debt stabilization. Elevated debt sustains higher yields. Higher yields suppress private investment. The cycle becomes structural rather than cyclical. The global economy does not pause while one country recalibrates. Europe is strengthening industrial policy around green manufacturing. Canada is positioning itself as a stable North American platform integrated into European trade architecture. Asia continues diversifying supply networks. If the United States remains defined by tariff volatility and fiscal strain, its competitive position may gradually narrow. And here is the unresolved variable few are openly discussing. If unemployment crosses 9% while federal interest payments approach $2 trillion annually, political pressure for aggressive fiscal intervention will intensify. Financing that intervention at elevated yield levels would expand debt further. Markets would then reassess sustainability thresholds. That reassessment would not be announced in a speech. It would appear in bond spreads, currency movements, and long-term capital commitments quietly signed elsewhere. The 108,000 layoffs were not merely a labor statistic. They may have been the opening chapter of a broader strategic inflection. The defining question now is whether the United States can recalibrate trade policy, restore investor confidence, and stabilize employment before capital repricing becomes permanent. Because if the current trajectory persists, the structural consequences may define not just a year, but an era. 108,000 jobs lost in a single month. More than 500,000 announced layoffs within 2 quarters. Federal debt beyond $36 trillion. Trade war escalation, reshaping supply chains. Capital gradually redirecting toward Canada and Europe. These are not isolated data points. They are interconnected signals The United States remains the world's largest economy. It retains innovation capacity, financial depth, and institutional strength. But markets operate on confidence, not declarations. When employment weakens, borrowing costs rise, and policy unpredictability expands simultaneously, capital reassesses exposure. Canada, through stability and diversification, is capturing part of that reassessment. The outcome is not predetermined. Policy recalibration could restore equilibrium. Trade normalization could reduce volatility. Growth stabilization could rebuild confidence. But if the trade war intensifies while fiscal strain deepens and unemployment accelerates, the repricing of American risk may extend far beyond the current cycle. Is this a bold strategic reset that will ultimately strengthen the United States, or a high-risk gamble that is isolating the economy at a fragile moment? The answer will not emerge from rhetoric. It will emerge from the next wave of data and from where global capital chooses to go next. Thanks for watching.